Okay, I think we are good to go. We're here once again for another week of our Selfwealth Live Technical Analysis Edition. My name's Roger, and I'm from Selfwealth by Syfe, and this is Jason to the left of me. How are you, Jace? How are you?
Hey, Rog, I'm good. I'm good. I'm looking forward to another show. Plenty of interesting things to talk about this week, I think.
I think so. It looks like America's topping the highs once again and leading the charge in the capital market. So it's good to see a lot of the stuff that we talk about, especially you're talking around staying with the trend and just until things change, is playing out in some sense, right? So good to hear that. But let's get on to that very soon with our analysis. Welcome everyone on the other side of the line. Thanks for coming along for another week here on our show. If you're a new person to the show, then obviously we go through the Australian market, we go through the US market, and we go from the Hong Kong market in terms of how the price charts look from a technical analysis perspective, our technical analysis perspective, that is. Then if there's any general questions, we'll try and answer them. And then we give it to you guys and you can provide us with one ticker. We can have a look what to analyze in your tickers from a technical analysis perspective once again. We do have the promotion going as well for the one final week, the Selfwealth promotion that we've been going for all of October. I will explain the rest of that once you've done your disclaimer. Thanks, Jace.
Yeah. So everything today, general commentary only. So no personal advice today in anything that we do. And I'll quickly put on that disclaimer we look at each week. I'm also not part of the Selfwealth team. My business is Motion Trader. So my details are at the top with all the licensing, etc. in there. And beneath there, the Selfwealth disclaimer, general commentary, licensing, again, all that stuff is in there.
Fantastic. Thanks, Jay. So I'll just quickly go over for the final week of our October promotion. It'll be in the terms and conditions down the bottom of this video after we finish this video, the full promotion details. But basically, if you are not a Selfwealth client and you would like to try out the Selfwealth platform, you will have access to 20 free trades. 20 free trades valid for 6 months. So if you all you have to do is sign up to the platform. There's a link. There should be a link down below on the video to sign up. And then once you have your account, you can simply email your account number to the email address sales@selfwealth.com.au, and we will credit you those 20 free trades for you to use for the 6 months. That's valid for brand new clients only, and you've got 1 week left. You do need to use a code word, and I was thinking about this. I'm going to use the word Douglas, and it's after Mark Douglas. Have you read the book Trading in the Zone, Jace?
No, I haven't read that one, Rog.
Well, it was one of the first books that I read, and it's a fantastic book around obviously trading and investing in general, all to do with discipline and confidence. I read it, and funnily enough, I think in my years of trading, I lost a lot of money because I wasn't very disciplined and very confident. But I can say now that I relate to a lot of things in that book now after being reasonably successful in my share trading journey with you over the last 2 years. So it's funny how you can always look back and think, oh yeah, why didn't I just be that way before? But you're chasing a lot of quick wins at the start, right? So it doesn't always work out that way. But anyway, the code word to apply for that promotion this month is Douglas. All right, so that's the code word if you are going to apply. Final week, so make sure you get your application in before Friday this week. Okay, Jace, over to you. Let's get into how that Australian market is looking.
Okay, so I'll start off with the ASX 200. And yeah, so on the surface, it probably looks like it's been pretty quiet really the last couple of weeks. But there's actually a fair bit going on internally. We're going to have a look at a couple of key sectors in a moment. Overall, though, I think the price action tells us a lot about the state of this market generally. So just look at how the ASX 200 has been, since this rally, had this rally off the 50-day moving average about 2-3 weeks ago, and look at how it's been holding on to those gains since then. So when a market has a strong rally and then a modest pullback and it holds its gains, maybe it trades sideways, as has been the case here, it tells us something important, and that is that investors are generally buying the dip. And I think that's what we have here. The fact that prices are holding onto those gains, I think, is a bullish sign. And I think that we're in an environment where the pullbacks continue to be bought. Underlying structure remains positive. We've got the rising moving averages, the 50-day and the 100-day moving averages continue to push higher, prices above those averages. So I think the odds favour playing to that backdrop, not betting against it. And I think it's also worth having a look at those two largest sectors, which I was just talking about a moment ago. So starting with the financials. So this is interesting to look at just today, in that financials are breaking higher. I've been discussing, I think we might have had a look at this last week. I've been talking about it in my Friday strategy sessions as well. We've now got a breakout in the financials, and that follows this 2 months of consolidation along the moving averages. I think that the consolidation that we've seen the last couple of months, I think this sets up a platform that we can see higher levels come from in the coming weeks. Coming over to the materials sector, which includes a lot of the mining stocks, having a look at this as well. Well, it's pulling back. It's been pulling back over the last probably about the last week, and that follows a strong rally off the 50-day moving average back about a month ago, touch over a month ago, had that strong rally off the averages. I think given the extent of that rally, this pullback really shouldn't be surprising. In fact, I think it's probably overall it's a positive, as pullbacks help consolidate a trend and help make a trend sustainable, because trends just don't keep moving upwards and upwards and upwards all the time. You've got to have those pullbacks along the way. But I think the biggest development here, when we compress this chart a bit and get a bit more history on it, I think the big development is that the materials seem to be breaking out of this big 3-year trading range. We're now starting to get this lift out of the range. So yes, there's a consolidation which I think is likely to continue for a bit longer yet. Really, when you get these strong rallies, it takes more than a couple of days to correct and consolidate them. But when you look at it in the context of this big trading range, which prices are now pushing out from, I think that's positive for materials, which then flows through being positive for the market generally. And I think those odds favour higher levels in the coming months. So when we come back and we look at the ASX 200, near term, we could see more consolidation. Prices could even come back and retest the 50-day moving average. That wouldn't be anything untoward, I don't think. But I think the sensitivity remains to the upside. And I think that's what the price action is suggesting to us. And I think we should be positioning our portfolios accordingly, and that is remaining long stocks. This remains a bull market.
Yeah, I've noticed a few of my stocks dip into the negative, especially in the especially in the commodities sector there, Jace. Now, I guess I've learnt to be calm around these times. As you've said, like a lot of these markets are relatively extended now, so it's natural for have this pullback. How would you say? I mean, if for those that are getting a bit sort of scared now around, obviously, what media is saying a lot around being tops and all that, how would you handle seeing a bit more red than usual in your portfolio?
Well, I've got some red in my portfolio today too. But again, this shouldn't be a surprising thing. This is something we've spoken at length about, particularly I have in my Friday strategy sessions. It's like we look at the ASX 200 and it's been pretty quiet, but a lot of the movement has been in the small ordinaries, which has risen considerably, and then also in the emerging companies, and this includes a lot of the smaller mining stocks. Like, yes, today they're having quite a sizable down day, some of them, But it's on the back of extraordinary gains over the last few months, and for several weeks I've been going on and on about be careful chasing extended stocks and continuing to buy. FOMO type buying in the last few weeks, because this has been, emerging companies have been historically stretched above their 50-day moving average. I do this in this Friday strategy sessions where I've got more time to go through all this, and it has been extended, and we're now getting that pullback to the averages, which was always going to happen. So and this is where I've been saying, just be careful with being overextended or overexposed to commodity related stocks, getting overexcited about gold, using leverage, buying all the way up, not just having an initial position at the breakout, but going buy, getting overconfident, buying more. These are the people who then get themselves into trouble, and on days like today, start selling their portfolios, because their whole portfolio quickly becomes underwater because they've got these high average entry prices. This is, when you look at this chart and you look at this pullback, it's like, well, it's a bit of a pullback, but look at the rally that preceded it. It's proportional at this point. It's people talking about bubbles and crashes and all sorts of crazy stuff. That's not the price action we have at the moment. And then when we look at the ASX 200, the ASX 200's not doing that either. We've got the financials breaking out to the upside, which makes up about a quarter of the market. That's a positive. So I think we've got to take a deep breath, stick to our strategies, know where our exit stops are, and if our stops get hit, we close positions out. I'm not interested in buying dips on stocks which are rapidly pulling back. Leave them alone and exit if necessary. But this is where wide trailing stops come in as well. It's like they're wide for a reason, and that is because we can get significant volatility in stocks. It's like one of my stocks I was looking at earlier on today. It's having a large down day, but it's this copper stock. It's down. What is it down today? It's down 9% today. So you say, oh look, I've got a stock that's down 9% today. It sounds like it. You'll read some news wires and they'll say, such and such stock is crashing today. But look at it in the context. Look at it in the context of what's come. It's like, yes, there's going to be volatility, and you're going to get big upside. Also comes with unpleasant pullbacks. It's part of the course. So look, every stock needs to be treated on its individual basis, know where its trailing stop is. But again, we use wide stops. I'm always talking about stops below the 50-day or below the 100-day moving averages, giving them lots of room to move. And if we could just have a close stop, that would be great. But you get bucked off the trend all too many times. So look, it's an interesting time, Rog, but I don't think it's an unexpected time that we are getting this volatility.
Yeah, I love the term crash that a lot of people use in the media as well, especially around gold. It's already crashing, right, according to them. But
it's like all up a chart, and it's not crashing. Anyone who says that is after hype, and they're after sensation. They want you to click on their link, and I'd probably not click on their link, because it's really, if you've got to use that sort of sensation to get people to look at your story, gold is not crashing. It is it's down from its highs, but it was also, as I've spoken about at length over the last few weeks, it was historically stretched above its moving averages, and this pullback has been all but to be expected. And it happens. It's not one-way traffic, and it's not a crash. Now, it's not to say things can't spiral or get worse and things can't crash, but that's currently not the situation. So it's people read that sort of nonsense story, and they go out and they sell their stocks and panic, and then a month later they look at it, everything's calmed down, and things have recovered. That's often the sort of things we see. So it's people should pull their heads in with some of these sensational stories they come up with, and keep it cool, follow your plan, and sometimes switch off some of the media, which just they FOMO people on the way up, and they panic them on the way down, and it just doesn't help.
Yeah. All right, let's look to the opposite of a crash at the moment. Let's have a look at those US markets.
Yeah, so coming over to the S&P 500. Well, remember that 3% down day about 3 weeks ago? Well, hasn't that quickly faded into the background with new all-time highs just in the last couple of days? It's interesting when we look back at a chart, and it's easy to spot like a few. Look at a few of these volatile days where we did get these, some sharp moves to the downside. And at the time, I'm sure a lot of people thought they were a big deal. And as we just discussed, there were probably some hyped up headlines around them as well. But when you look back at them now in the context of an upward trend, look, I think a lot of people probably wouldn't even remember what caused some of these down days. I know I certainly don't remember. I had to look it up to see what actually happened. But yeah, at the time, big deal. Look at this in the sense of a trend, not such a big deal. That last 3%er, well, yeah. I had people sending me emails telling me the market was going to crash the next week. Well, yeah, as we can see, it didn't happen. And that's how uptrends work. They aren't accompanied by a smooth flow of good news. That would just make everything way too easy. Instead, they give us plenty of reasons for fear and doubt. And that's what leads to like some of these pullbacks, which we get along the way. But despite the fear and doubt, the S&P 500, it remains in an upward trend. That's been the case since prices got back above their moving averages back in May. And that's been the consistent theme we've spoken about. Stay with the trend, see where it goes, give it room to move. I was talking about the Magnificent Seven in my strategy session on Friday. And there's an ETF which tracks the Mag 7. It's called the Round Hill Magnificent 7 ETF. It's listed in the US. And I was pointing at the price action that we had just over the last month. So we had prices plateaued for a couple of weeks, and we had a sharp pullback towards the moving average before a quick rally back to near the highs. And that's in my experience, that type of price structure typically leads to new highs. You get this false break to the downside and that quick retracement. It's that sign of the interest is in buying, and that's of course what we've seen on this occasion. We've seen that break to new highs. So I think the breakout we're seeing now, I think it adds to that bullish backdrop. I've got an interesting slide I want to show you. It's an update on the American Association of Individual Investors survey. We spoke about it. We actually had a look at this last week. So last week we were talking, well, just to quickly sum it up, the key point that I made last week is that we've got above average bearishness and below average bullishness at an all-time high. So last week we were talking about there were 46% of the survey respondents were bearish versus 33% are bullish. Looking at it this week, latest survey is similar in that it's 42%, I'll say 43 if we round it, 43% are bearish versus 37% who are bullish. So there's been a few less bears, but it's still an above average bearish reading. On average, historically, 31% of people are bearish. We've currently got 43% of people being bearish. It's a survey. Surveys are surveys. What people say and what they do often can be different things, but nonetheless, this persistence in the bearishness against a bullish backdrop, I think it's a fairly unusual thing to see. And I think the fear and doubt that's showing up in the survey, I think that lays the foundation for the next rally, the rally which seems to be breaking out now. Just looking at S&P 500 again, I think it's a case of staying long while the conditions remain bullish. And as always, using those wide trailing stops, try to see off those pullbacks as they come along the way. But just trying to stay. For me, it's about staying with this trend until I've got reason to not want to stay on this trend, and that'll involve prices breaking down below the moving averages, consolidating beneath the moving averages, and the averages turning down. That's when the structure starts to change for me. But at this point, that structure does remain up.
Yeah, it's fantastic. Just stay on the trend until you see reason. And just having that concept of market structure has been so important for me over these years, right? Whether it's an individual stock or just these indices, having this concept of understanding how market structure can change and break of structures and things like that. It's been a fantastic concept, which I wish I had learned a lot earlier. That said, let's have a look at Hong Kong market then. Thank you.
Over to the Hang Seng. Last week, we got a good balance off the 100-day moving average, and prices are now starting to stabilize around the 50-day moving average. There could be some more near-term consolidation, but the underlying trend here remains up. There's nothing bearish on this chart at this point. At this point, it's an upward trend with a pullback. See if there's some more consolidation, but this is a trend I'd want to continue staying on. And but the real interest has really been over in China in the last week. This has been the strongest price action out of the two of them, and we've now got this clear break above this resistance band, which comes in at around 15,000. Let me just compress that, and you can see this goes back about a decade, where there's been strong resistance, and then it's been support at other times. More often than not, it's been resistance. So prices have paused around there over the last few weeks, but now we've got this clear-cut break. This is a bullish trend. I think there's plenty of upside potential over time. Of course, there's going to be more consolidations and stuff along the way, but look, I've got a position in this market through an ASX listed ETF, and I'm happy to stay with it and see where this goes. It's interesting. It's China's a market which has been shrouded in probably negative commentary mostly. That's what I tend to see. It's China, the Chinese economy tends to be treated quite downbeat when we hear about it on the news. But the price action over the last for much of the last year, it's been telling us of a potential emerging bullish phase. Not what you'd expect when you hear some of the news reports.
Yeah, it's fair enough. I did mention to my wife she's on a work trip over in China at the moment over the last week, and I did mention it's maybe the up in China is because she's over there at the moment, right? So stay over there while we're invested in the Chinese market, right? That might be a thing. All right, fantastic. Let's get on to some of these tickers. Let's just start off with the gold. Gold and silver. Now, obviously, we just talked about the crash thing, but how do you see it from a technical perspective?
Look, I really cover this in my Friday sessions. People should come over to those and go through all the information. I spent about 20 minutes on gold last week. But just in brief here, this is still a rising trend. Prices got well above the moving averages, and we're now getting a pullback to the averages. I think there's every chance we see price reconnect with the 50-day moving average. That could be a combination of the moving average rising, price could go sideways, price could come back faster. But it's that big trend does remain in place. But strong upward moves, as we've seen in the past, strong upward moves they'll lead to these longer consolidations. I'd say I think the highs for gold could be in for several months, possibly more than several months. Could be in for like a 3 to 6 or even 12-month consolidation. Like you look at some of these past big peaks, it's they can lead to lengthy consolidations. I don't think we're going to see a quick return to new highs, but my weekly strategy sessions, if you're not a member of those, go over. They don't cost much to join, and you get a lot of information about this. There's all sorts of overlay charts and stuff. They take a while. We've got lots of stock codes to go through, so I can't do that here. But that would be the place to go for more on gold, and silver's in the same situation. It's moving to a large extent with gold. It's a pullback. to the moving average. It's a sharp pullback, and I think that tells us that there's more consolidation to come, either in terms of time, where it's like, you get big sideways move, or price, where prices do pull back more, and these might get more of a zigzag type pullback. We don't know how it will play out, but I do think there's odds favour more consolidation, but the big underlying trend, it remains to the upside.
Yeah, that's fair enough. And obviously,
but do expect volatility in the underlying stocks. This is why wide trailing stops, I think, are so important for trying to stay on these big trends. If we're just trying to use 10% or 15% or even 20% stop losses, you'd probably be out of a lot of positions already, because they can quickly move around some of the stocks in these sectors. To stay on those larger multi-year trends, it's big trailing stops are essential, and that doesn't guarantee you stay on either. So it's spreading risk, sensible weightings within portfolios. One of the things I've discussed in recent times is not getting so excited about one particular sector that you find that 3/4 of your portfolio is weighted towards gold or tech or whatever it may be. Having that spread across various areas is, I think, an important thing.
Yeah, exactly, and help filter out all the heaps of signals that you might get as well, right? So, okay, now let's have a look at some viewer stocks. Let's start with BMN, and while you have a look at that, BMN for Nelly, don't forget, as Jace mentioned, you can there's a link down below for his strategy sessions where you can get a trial to start off with as well, right? So don't forget that link down the bottom there.
Well, the link down below would be for the Motion Trader service,
okay.
The full Motion Trader service. The strategy sessions are a separate service. It's a low-cost service, which I do on Fridays. So you go to the Motion Trader YouTube page for that, and you'll see the strategy sessions I do, and there's a link within the strategy sessions. There's a free version that comes out on Saturday, and that's got a link through to the full session, the live session I do on Fridays, where you can, like today, you can ask about stuff, and has a lot of details on the commodities and stuff. So you'll find that from the Motion Trader YouTube page.
Perfect.
So Bannerman, and this is like uranium's in a bit little. I think uranium's delicately poised at the moment in terms of, like, just looking at uranium first. We've got this pullback to the moving averages underway. I think it's a critical time. I would really need to see this low from a couple of weeks ago hold. Otherwise, uranium starts to give back this entire rally since July. It was a strong rally from July. I had hoped to see price stabilize above the moving averages, but it has dipped below. So far, it's like rebounded from there, but I think a retest and a break, then we get a series of lower lows, and the whole uranium story starts to become a bit wobbly, at least for the coming months. It might be a longer consolidated period before we could potentially see a trend emerge. Looking at Bannerman, looked like we had a breakout underway a couple of weeks ago, and that's now I think we'd call that a false break. You can see the resistance points, prices broke above there, now back below there, back below the averages. The averages are starting to turn. I've got some Bannerman myself, and I'm looking at it's close to being at an exit point for me. We could get a bounce in the near term. This has been a bit of a one-way traffic decline so far. It's not a dip I want to buy at this point. I'd want to see it stabilize, get back above the average to consider buying. For me, it's now a case more of like, will I sell, or do I give this a bit longer? At the moment, I'm holding in there, but a lot's going to depend on uranium. Is the uranium price, how's this bounce going to play out? Is this bounce going to be able to like push prices up a bit further and then consolidate, hold on to those gains, and the whole sector starts to stabilize? Or is it going to quickly give it back and we're retesting the lows, in which case I'll be exiting my uranium stocks. So Bannerman is hanging in there at the moment, but only just. I think it's a stock to consider where an exit would be, and should it get there, probably don't hesitate to pull the trigger if need be.
Okay, fantastic. G'day, Robert. Let's have a look at MEI, please.
Yeah, look, it's gone up quickly and it's come back just as quickly. It's at the averages now, so this is where initial support should start to come in. Like a lot of the stocks we've looked at in recent times have been, like in recent weeks and in our session, Rog, there've been a lot of low price stocks which have gone up really quickly, and low price stocks are notorious for shooting up quickly and then coming down just as quickly. It's like some go on become much bigger companies and go on to greatness, but as a general proposition, they their support tends to be fickle, and they can come back. So we've talked about strategies about taking skimming some off the top, taking some profits if there's a big gain in place. These are the ones where we can expect the most volatility when conditions change, as we're currently seeing. If I was holding this one, assuming I'm in at a good level earlier on, I'd continue to hang in there. I think this is a key point now. It really needs to stabilise around current levels, around the 50-day moving average, near these recent highs. If it starts getting below the 100-day moving average, it's like it's probably going to be an exit for me. Yeah, look, I'd probably be saying, look, down much, guess down to 14 cents or much below there. I'd be looking to close it out, but I could give it a bit more time at the moment. And we could also, another thing that could happen is we get there could be an initial there could be a rebound off the averages, or also because like this has been a large and fast, relatively large, and it's been quick. We also could get like the rebound rally. That could be an opportunity to lighten, to exit if someone was like going, I actually got too much and I've now realised I've got too much, I've got to get out of some. But I think this will be the theme today. Stocks quickly coming back to their moving averages. And it's like, well, we've talked about when conditions are calm, think about what your exit strategy is. Now things are getting a bit hot. It's like, well, okay, well, we should know what our exit plan is, and it's implementing it if need be.
Yep, fantastic. All right, let's get our Astro. Let's have a look at SPZ, please.
Yeah, this is continues to be structured nicely. Very different situation what we're seeing in the in some of those mining stocks. It's got the rising moving averages. That's been the case for some time. It's got this what would that be? That would be nearly a year of consolidation, really, where it's just traded sideways. But it has been since the April low. It has got this series of rising lows. We get the rallies and the pullbacks, and then in recent times there's been a rally, a pullback to the moving average, another rally. So it seems to be stepping higher. Maybe there's another pullback just towards the moving average, like that could get a move like that, and that could complete a pullback before we get higher levels. If I had it, I'd continue holding it. I probably wouldn't buy it just today. Just looking like the All Ordinaries, the ASX 200 might have a bit more consolidation. Maybe it's got that another pullback to the 50-day moving average. But if it did pull back and then start to bounce off that could be an entry point. Exit point for me would be below the 100-day moving average, which is only about. This is for an initial entry. Should one develop like about 16%. So the potential initial stop. But if someone had been in this for a while, I'd be using the wide trailing stop. My trailing stop would be back around, it could be down around in the mid 70s somewhere.
Okay, fantastic. The next one is PLY, please. Hey, Kirby.
Little bit early for me, although I can see the moving averages have just crossed. It's like, it's rallied above now. It's come back and it's consolidating on the averages. I think it's a case of, for me, it'd be a case of I want to buy into some upward momentum now the moving averages have crossed. So the high is 23% away. Like it's a lower price stock, so a few cents makes a reasonably large difference. I'd probably want to see a bit of a rally off these averages, and then a consolidation where it holds onto those gains, and then that could give the opportunity to sort of get on board, and then have the stop back below the averages, back below these recent lows. So I'd hold off buying for the moment. But if I'd already bought, and I was already in there, well, it's the structure's starting to improve, and maybe this does turn into a trend. So if I was on board, I'd probably stay on board, and I could have a stop. Like we could use these lows from early October, somewhere back below there, back into the the mid-teens somewhere for an exit point. So if it breaks down below the averages and the October low, it starts to make new lower lows. Well, then I'd probably say, look, I want to protect capital, close it out. If it hasn't developed that upward momentum and instead starts to slide, but if it can hold here and then start to rebound, well, all good. So yeah, I'd hang on if I was in there, but I'd hold off buying if I wasn't. Just wait for more of that price action.
Okay, very good. Good potential future opportunity there. Hi, Mick. Let's have a look at WOW. WOW.
Yeah, the downtrend continues. A stock to avoid. Like this left the motion trader portfolio a long time ago. Yeah, look, it's been, and it also has been. It has been actually looking at it. Has been a difficult stock because it's given us several false starts where it's declining below the moving averages, then it gets back above the averages cross, and it looks like maybe there's going to be a recovery. So it's a sort of stock which can trigger false entry signals, gets you in on the potential of emerging momentum, which momentum then quickly fails, and you end up hitting a stop loss. And I think this actually happened a couple of times in the motion trader portfolio. There probably would have been a recent entry in August. So rallied back above the averages, consolidated, started to break higher, and then went into another decline. I would have sold this one if I had it. I think it would have hit. It may still be. If there was an entry in August, it's probably just about hitting its stop now. If I had it, I'd probably be looking to get out. Well, I would be looking to get out of it. It's been a difficult stock. It hasn't followed through on the upside. At some point, it's probably going to base and be a great stock again. But it's you look at this price action over the last 4 years, and it's just been it's been disappointing and hasn't been able to get going every time whenever it's got to start. I don't want to try and pick the low on it, because picking the low on it has not been a successful strategy unless you're like really quite short term in your approach, which I'm not. So picking the lows hasn't been a success. This stock I'd just leave alone.
Yeah, it's interesting that with the Woolworths being the company that it is, you'd think it'd have better price performance. Show that, and I don't know anything about the fundamentals of this company, to be honest. But obviously, we see it in our daily lives, the Woolworths Group. But from a long-term perspective, you look at that, maybe not so bad. But yeah.
But this is what people think. People think, oh, look, I know the company; it must be a good company, and this is the rationale behind. Some people, and they'll have a blue chip approach, saying, I only buy stocks which I know. and they know Woolies, and they go there, everything looks good. So you think, okay, this must be a good stock. And well, it depends on where you bought it. If you bought it back in 93 and you've just been buy and hold and you've collected the dividends, you've done really, really well.
You're right.
But nothing's one-way traffic. Like look at this period from 2014 where the stock fell nearly 50%. So like it's easy to look at this weekly chart and everyone just sees a big sweeping uptrend, but you get these difficult years as well. So that's from 2014 through to that's 2 years of unpleasant price action. Then you had the other, this other period from 2007, and that went on for like 4 years and a 33% decline. So even really good stocks will have periods where they don't do as well. Look at the stock like Microsoft. It's had big corrections along the way, although it's been one of the greatest stocks of all time. So what will happen this time in Woolies? Well, of course, I don't know. It's down 40%, so it's not as biggest correction. That was during that looks to have been during into 2016. Have we seen the all-time high ever for Woolworths? Probably not. I think odds favour it will make a new all-time high at some point. So if you're a buy and just hold, well, maybe you keep doing that. But if you're more an active investor who's like aiming to capture like these big middle parts of trends and not stay in a stock for a decade, but be in and out of stocks within maybe a year to three. It's not lined up as an opportunity at this point. So there's different ways to invest. There's no best way for everyone. Active investing can work really well. Buy and hold can work really well. If you buy the right stocks, buy and hold is generally better done, I think, through an index ETF, not individual stocks, because Woolies has been great, but there'll be for every Woolies there's probably, I don't know, a dozen or more stocks which haven't been great. So, what your time frame is has a big impact on how I think you view this chart.
Of course. All right, let's have a look at Just Why. Just Why, the NXL, please. G'day. CEO resigned yesterday, causing a 16% drop. Well, hopefully he sold his shares before they dropped.
Yeah, well, look, if you look at the price action, it wasn't a bullish trend at the time. It was like prices had recovered from they'd been through a large bearish phase, which was like, so this was a motion trader stock during 2024, and it came back and it hit its stop loss or hit its trailing stop, and it's been out of the portfolio for over a year now, and there hasn't been a re-entry signal. This was looking encouraging, had a rally, modest pullback, another rally, consolidation back to the moving averages, another rally. It looked like another consolidation. The moving averages were just staying across. So it would have been at the point where I would have been saying, okay, if this can now establish above the averages and move to a new high, well, that's going to be a sign of momentum and worth consideration. But instead, we've got another drop below the moving averages. I wouldn't want this stock in my portfolio at the moment. It certainly wouldn't be a buy, and if I'd bought it in recent weeks, I'd probably close it out, because like we've got this gap lower. We didn't have an established trend. We just had the potential makings of one. Even if it stabilizes sometime soon, it could still be weeks of just back and forth chop while it reestablishes a base, gets back above the moving averages. This is on the positive side if it were to do that. So even a positive tilt towards this stock could still take time, but nothing to say it can't continue to come off in the weeks ahead. So I'd leave this one alone. It's not a stock I want to be involved with at the moment.
Okay, thank you. G'day, Jen. Thanks for the lovely compliment once again. Well, we've already looked at gold though, so we've got gold. But thank you, Jen, for the comments. Let's go to Dan's ARU, please. I was just in awe of Jen's comments all the time. So
good, very nice. Yeah, rare earths, very hot commodity in recent weeks, hitting the news most nights seemingly, and now we've got the pullback. It's like, it's not a surprise. This stock had gone from 20 cents to 60 cents. This is where we talk about, is it worth considering scaling out of a position once it's like up 300 odd percent, especially when it's super stretched above the averages. Of course, probably a little bit late for that now, but this is why we discuss these things. Of course, gravity has won, and the stock has come back towards the 50-day moving average, like it always does, unless the stock is suspended from trading or gets taken over or something. It always comes back to the averages. If I had this in my portfolio, I'd continue holding it, assuming I'm in as prices were breaking higher. If I FOMO'd, if I had a FOMO entry at 61 cents, I would have been out by now. But I wouldn't have had a FOMO entry because it's not a high probability way to trade. It's a good way to get yourself stuck in the downdraft of the pullback. But if I had a good entry into this one, look, I'd continue holding it. Like, my trailing stops are going to be below typically they're going to be below the 100-day moving average. So it's giving a lot of room to pull back. But that's what I'm. It's like also understanding what is it that you're targeting. I'm targeting trends that could run for 1 to 3 years, not shooting rockets which could go up for 2 months and then come quickly back down. It's a different type of strategy. Someone who's targeting a 200% gain in 2 months probably does have a take profit strategy or a close stop, but you don't get these moves that often. So I'm operating in the 1 to 3 year potential space. Hence, I've got wide trailing stops. I want to try and see off pullbacks, stay on larger trends. That's what I'd continue to do here. I may have scaled out some on this big upward spike, but either way, it's there is still an uptrend here, but I do think the excitement's over for the near term, and at best we're probably now into a lengthy consolidation. The other thing with these rare earth companies is it's like they're being fueled by pretty much by what's going on with China and the US. So China's restricting supply. Trump's coming out and saying he's supporting getting into the local ASX rare earths to an extent with what deals have been done there. So it's a hot sector. It's in the news. It could quickly become a cold sector should the situation change. Trump meets with Xi Jinping and they decide we're friends again, we're going to share our rare earths. Well, you can imagine that's not going to do too well for the rare earth company. So it's a sector to be wary of, and not be overly exposed. Don't want to be. I like trends that just build, and they build quietly, and no one's really focused on them. They're not making the headlines, and before you know it, they're up 200-300%, and no one's still heard of the stock. It's when stocks are, they're making the nightly news because they're up 50% overnight, and because of this and that, they're trends which can end as abruptly as they began. So I think being careful around a sector like rare earths at the moment. But as it stands, look at this chart. It is still an upward trend. If I was overexposed to it, maybe even still I'd take some money off the table now. It's just something to bear in mind.
Okay, fantastic. Hi, Alessandra. Let's have a look at NEM, please.
I've just clicked on the US. Actually, we'll have a look at the US listing. That's going to be where the data's better. So Newmont Mining, largest gold stock in the world. It was at historic levels of. I'll just quickly show you. Look at the weekly chart. and like you can see, it's only like been up at these levels, and this goes back to 1968. You can just see back there. So these are historic levels. And when it gets up there, it has had a tendency for pullbacks. And lo and behold, we're seeing the pullback now. I think there's still a medium to longer term bullish story with Newmont and gold stocks generally. But as we discussed briefly when we looked at gold, it may require months of consolidation following such a large run. People buying in near the top now getting scared and selling out, and that could take a while for this to consolidate. The overall trend remains up. There's nothing here saying, look, this is a top and there's going to be a bear market now. But I don't think we should continue the rate of advance which we had is going to quickly re-engage, and that this is going to quickly re-accelerate. I think it's going to take time to consolidate. So from a medium to longer term stance, a wide trailing stop I think is a good consideration. And I probably don't think there's a hurry to race out and just start buying up. I think there's time now to watch this and see how the price action settles, and then consider from there what the step forward is in terms of establishing a position or adding to a position. I don't think there's a hurry at the moment, though.
Okay, fantastic. Koala, we've done a bit of discussion around rare earths and ARU, so let's move on to the next one. D. Smith, let's have a look at TTT, please.
Yeah, look, there's still an upward trend in play, although like I think at best this is now a range bound stock. Had this quick rally. When we get quick rallies, what I don't like to see is just quickly giving all those gains back. When we get those nice big rallies, we want to see stocks holding onto their gains and consolidating sideways, not a quick give back. So there was selling interest as soon as it got to the highs, and there hasn't been the buying interest on the pullback. So that suggests to me that this is this is still going to take time. We could a stock like this, you could see a big range develop before maybe higher levels. Like this could be into next year. Like this could take several more months of just meandering sideways and then developing a larger base and then pushing higher. All sorts of price action could take place. This is just one possibility, but that's a bullish possibility. So I think this does have that bullish potential, but I think it's going to take time if that potential is to be realized. And if instead we get the price action continues to sell off and then we start consolidating below declining moving averages, then we get a weaker structure and it's a different situation altogether. I think this is one just to watch for now. If I was holding it from lower levels, fine, I could continue holding it. A wide trailing stop would might be sitting down around 20 cents or so. But I don't think it's an entry at the moment. If I bought at the peak, I'd probably be already out. If I bought it over in maybe around May, I might be going, well, look, using my time stop, I'm down a little bit. It looks like it's lost its momentum from now. Maybe I'd sell that. But if I'm in from these lower levels back in mid last year, well then look, I'm staying on this broader trend with the wide trailing stop.
Okay, fantastic. Let's have a look at a GGOV, please. It's an ETF on the ASX.
So a bond ETF. Look, there's a potential of a trend entering here. Like, has this been a basing period in the bonds, and they're now back above the moving averages? Had rallied, came back to the averages, rebounded off there. So there's got upward momentum to it. Series of rising lows. It could be an emerging trend. I think this has upside potential. Yeah, it's not one which we're probably going to see spectacular gains from. But look, not everything has to have spectacular gains. Different things can have a different purpose. So I think there's upside potential to it, and of course there's probably going to be a yield component that comes with it. So this may be an option for people who are after that bond type of ETF.
Okay, fantastic. Sorry, Caroline, I don't really know what if that's a code there, BCINCO. So we'll go to the next one. Brett, BC8.
Yeah, like it's rapidly. It's gold stock. It's been a great trending stock for well over a year. If I was holding this, like, I'd be using. Let's just put on a wide trailing stop. See where it is. So, well, the motion trader entry was probably around 34 cents thereabouts. So the wide stop has done a great job at keeping us all the way in so far, and this is where it would currently roughly be. The motion trader has a different calculation to this, but roughly around 85 cents. So if I had this, I'd continue holding it. It's getting it's not that it's closing in on the stop, although it's not there yet. Like, we look at this period, like that was looking ugly, and then things stabilized over several months, and then the uptrend resumed. So it's not to say that this can't look initially ugly, but then in several months' time we see that it's chopped sideways and it's got a base and it's ready to break higher again. That's why we use wide trailing stops. Like, all these pullbacks started ugly, but finished well. We don't know how this one will play out. That's why the trailing stop is wide. Give the price plenty of time to stabilize and push higher again. For now, I'd stay with it. I wouldn't be a buyer though. I'm not interested in buying a stock during this rapid corrective phase. I'd be on the sidelines from that perspective.
Okay, hi Sol. Let's have a look at MRK. It's on the New York Stock Exchange.
Little bit early for me, but it's getting into a position where maybe something happens. So I've had this lengthy period below the moving averages, and over the last 6 months or so, it's stabilized and made its way back above the averages. Averages recently crossed. To trigger an entry from the way from a motion trader style approach, it's really waiting for a break above the October high. That would be the entry signal. And should that happen, like, an initial stop could be, it could be just back below the what is the October low, just below the moving averages, could be 12%. And then you go, well, look, what's the upside? And I think it'd be an asymmetric play, because the upside is like, back to the previous highs, could be 40, 50, 60% or so. So that's, of course, only potential. We don't know whether that potential will be realized. But I think it's setting up the price action that could support higher levels, and it could be an emerging trend. So one to watch, but I'd hold off at the moment, because maybe we get some more sideways price action before a breakout. I'd wait. Although it does appear it's like we've got these rising lows. It does appear that we're going. I think the odds favour we're going to get a break to the top side.
Yeah. Okay, let's have a look at Gary. G'day, Gary. WWI, please.
Yeah, same as we've discussed with other stocks, and also being a low price one, being a 2-cent stock. Like this was a prime example of a stock which just in the last couple of weeks would have been a good candidate for scaling out of, with about a 300% gain from where things were in July. If I had it, I'd still be holding it. Wide trailing stop. My stop would be rough, just rough casting an eye on it. 3.5 cents thereabouts probably. So back below the 100-day moving average. The key for these smaller stocks is, do they actually have something of substance, or have they just shot higher because they've got mining in their name and they're got an interest in something which has been running hot? The key will be if they don't have something of substance, well then the risk is they go back to where they started from, and I think could well be the case for a lot of these stocks over time. But at this point, the price structure is, well, I don't think we're looking at a quick resumption of the trend. I could be wrong. I don't think we are, though. At best, I think it's that lengthy consolidation and see whether it can hold on to these gains. Not a buy for me, and it'd be a hold with that wide trailing stop. But also considering if I was overexposed, we could still look at considering taking some money off the table. Yeah, it's been given a bit back, but it's still up. It's still up considerably. I think the fun's over for now, though.
Okay, it's good to see you downloaded that Trading the Zone book. It's a really good book. Let's have a look at Kings, please. And it's A2M, please.
Yeah, looks encouraging. It's just consolidating around the moving averages at the moment. It's from a stock which was like a market favourite for a while. It really fell from favour, and we've had this large basing period. And you look at the price action since the November 23 low, and it's been a series of steps. So it rallies and then pulls back, rallies and pulls back, but it doesn't pull all the way back. It holds on to much of its gains, and now we've got another rally, another pullback. So it seems to be stepping higher. I think we're going to see higher levels. If I had some, I'd be holding it. Wide trailing stop, all the usual criteria there. It's like it probably could be considered as a buy at current levels, and like if it's bought at current levels, a more aggressive stop could be about 8%, just getting us below the October low and maybe back to the moving average, 100-day moving average. Or maybe giving it about probably 15%, because like what I'm also thinking, it's like this could rally from here. So that's why I say it could be a buy at current levels. This could be the consolidation nearly done, and it starts to move higher again. But I also wonder whether we could get more of a a zigzag type consolidation, not dissimilar to what we saw back in March. So you pull back, an initial rally, and then it had that next wave, second wave pullback, where you see so pullback, rally, and then you get the next wave pullback, which could come back down, and then from there, then you start to see the the building phase take off. So probably around 15%, maybe, if it was bought at current prices. Otherwise, it's a case of watching it, see if it rallies now, breaks above these recent highs. Well, maybe that's the entry trigger. Or if it consolidates in longer range, well, maybe it's just a case of watching it for another few months, maybe, while it tracks sideways. But an interesting one to watch. It's it's nice overall chart structure.
All right, fantastic. G'day, Jules. SVM, please.
Yeah, I've got some of this, but I don't think I'll have this for too much longer. Yeah, I bought up here. You know, prices had looked like they were breaking out, and I bought some. Sometimes it just doesn't work, and it's just about, it's pretty much at the stop loss now. So this is one I'll be moving on. It's yeah, look, it's disappointing when they don't work out, but you know, that's the thing. Lots of trades don't work out. The idea is you don't lose too much of them, and then move that capital into something else. I'm not about to just hold on and just say, look, I'm not selling until it gets back to where I got in, because the risk is, what if it's like got a, it doesn't draw that neatly, but just roughly, we could say we've had a big downward move and now we've got this sideways consolidation. Is it now breaking down? And maybe we get a bounce and then we're below the declining moving averages and the whole thing just sells away over time. That's always the risk. I'm not saying that's going to happen. That's the risk, and I'm not going to be on board to find out. So I'll jump off this bus pretty soon, I think. And if it rallies, well, great. But I think there's lots of technical damage done in the near term. I don't think it's going to be a quick return to a trending environment. But if that happens, it happens. I'm more concerned about the risk at this point. So yeah, it's one I'd rather close down than run with.
Okay, fantastic. Go stock follower, RHC.
Downtrend. It looked like maybe it had something. It looked quite encouraging. If we looked at it just back here, this looked encouraging. It had gotten above the moving averages, had pulled back, had a sideways consolidation in the averages. I would have been saying this was set up for a push higher, but they don't all deliver, and this one delivered to the downside. It's that plenty of technical damage done with that decline. I would have been an exit for me on that decline in August, and I wouldn't be looking at it now. It's got to get back above the moving averages, get re-established, averages have to turn. All that's probably going to take some time. So for me, this is just a stock to I'd want it out of my portfolio and not worry about it, and can potentially revisit in the future if the price action warrants it. But yeah, it's not for now.
Okay. G'day, Damien. Let's have a look at UOS, please. I would like to trim my holdings. It doesn't seem to be moving. It's just a matter of wait. Is it just a matter of waiting until it gets some attention?
Yeah, well, look, this is a stock which most people wouldn't have heard of. Doesn't have a whole lot of liquidity. You can just tell by the price bars. It's all over the place. Look, it's got the makings of. It's an emerging trend, so it is like generally has rising lows, rising highs, rising moving averages. It's just pulled back. It's sitting on the moving averages, which it's done in the past, and then it's rallied off. So it does have upside potential to it, but how quickly that's delivered, if at all, we don't know. If look, it's as one part of, say, a 30 or 40 stock portfolio. Maybe I've had this in the past, these obscure stocks which just didn't seem to be doing too much, and I've just let them sit there, and they've done great things, and that can happen. These smaller stocks no one knows about, they can start trending. It's not like a 2-cent stock where there's probably some substance to the business. We could look at this in 12 months or 2 years' time, and it's done really well. So sometimes being patient and having, like, if it's one out of 30 or 40 stocks, it doesn't matter that it's not doing anything exciting at the moment, as long as it's not doing anything which is negative, and there's maybe it's slightly in profit or modest gain. Maybe there's not a problem with holding it. That said, if capital's tight and there are other opportunities and it's not moving much, there's nothing wrong with moving something on and reallocating the capital elsewhere. But just because a stock isn't doing much, it doesn't necessarily, for me, mean that it's a sell. If I was in at a lower level, I'm in profit. Yeah, often I'd just let them sit, and sometimes they really come good. Other times they get out later on if they start to pull back. Nothing exciting about this chart. It's just really a commentary on sometimes being patient and just letting a stock sit. It can pay off. I don't know what will happen, of course, with this situation though.
All right. Hi, Peter. Let's have a look at ASB.
Yeah, defense stock. So another one which is like running hot. At this stage, it's a pullback to the moving averages. It's a motion trader stock, has been for some time. Wide trailing stop. If it were in my portfolio, I'd keep it there. I'd know where my trailing stop was. If it comes back to that, well, fine, I'll sell it. If not, I want to see if I can see off the consolidation. I want to see whether this trend can extend to higher levels. At the moment, it would be a hold for me. It wouldn't be a buy. I want to see it just stabilize around those averages. Might take a bit of time because it has had a big run. We can look at it later for a potential buy, but for now, it'd certainly be a hold if I had it on board.
All right. Hi, Neil. Let's have a look at OBL.
Yeah, I've got some of this one. It's not doing anything exciting at this point, but it has the potential to do something interesting. I think it's really been consolidating since we could say since May. You can just see the price action just seems to be compressing. If it can like hold at the moving averages and then start to rally off them, you get the potential of price action like such, and you get the breakout, and then the rally really starts to lift. That's I think that could happen. I don't know that it will happen, but it's certainly got that potential. If it were to break below the October low, and then we start getting some downside vulnerability coming in, so prices below the moving averages and some lower lows, then it starts to lose some of that appeal. So it's in the motion trader portfolio. There's a motion trader stop loss on it. That's probably the play here. For now, it's I'm treating this as being a potential emerging trend. So we've gone from below the averages, we've flipped above it, consolidated into the averages, and now we're getting this larger consolidation. It could be that emerging trend and process. The key will be, does it rally off the moving averages and make new highs, or does it just continue to slip? So at the moment, I'd have a positive bias on it.
Okay, fantastic. Ozogster highly recommends your strategy sessions there, Joe, on Friday.
Thank you.
Let's get a wish blessing. Let's have a look at TLX, please.
Downtrend still in play. I'd leave this one alone. Yes, we've rallied back to the 50-day moving average, but is it going to be sell the rally, or is it going to be sell the rally and prices go down and make new low, or is this actually a turning phase? I'd just be watching it for now. If I was like, we've got some rising lows. That's encouraging. But I think to buy now, it's preemptive. We're preempting that a low's in and then the momentum's going to start. Now, there are strategies to play this. So buying at current levels and having a stop below the recent low, for instance, because we've got that series of rising lows. So we could buy at current levels and put a 15% stop on. I'm not going to do that because my process is about buying above rising moving averages, not below moving averages, which have still not turned. But look, that's what I do. If you're using 10 and 20-day moving averages, maybe you do start to have a crossover. So time frame, strategy is all going to play into this. for me, that path of least resistance is down, so I'll leave it alone. But I can see how somebody would decide, look, I think maybe this is starting to turn higher. I'm going to be preemptive. I'm going to use a stop loss. I'm going to try and get in early. If that's your play, well, there's nothing wrong with that either. It's all about assessing what's my downside and what's my upside. So if downside is 15%, maybe you could reason upside is a multiple of that if you get the turn right. So as long as risk reward stacks up, yeah, these things can be considered. It's when people are buying, I think, in this phase, the falling phase, just making low after low. That's like, well, how are you going to manage risk around that? You're just going to guess. You're going to say, oh, look, I'll just guess 10% below. And it's like, well, you've got nothing to hinge that off. At least here, we've got like a low we can use if we want to try and be a little bit more preemptive. So at least it's going with some momentum. It's not enough for me, but there's different ways to do things.
Okay, fantastic. We'll finish off on this ticker. CSL, please. It's dropped over $30. It's time to exit or buy the dip.
Yeah, we've been talking about this stock being an exit for a while. Broke down. We covered this, and it's and it was an avoid. It was an avoid in August, and it's an avoid now. And look, here's an example of a stock rallying back to the 50-day moving average, like we just looked at with our previous stock. And look, had you taken that more aggressive approach and said, look, it's look, I'm going to preempt. This is a turnaround. Got this little reaction low here from October, so I can buy this pullback. I can just set a tight 6% stop. And I think my upside's, way back in the range. It all stacks up. But the problem is when stocks are below their moving averages, the surprises have a tendency to be to the downside. And so whilst you might have calculated you had a 6% stop loss, it hasn't actually traded. You haven't been able to actually exit until a lower level. So you're actually carrying more risk than you thought. So, these are the dangers of trying to get in early. So yes, there's a strategy around that. It's a valid strategy, but it comes with risks. Look, I'd leave it alone. Like, where's our upside in buying this stock at the moment? It could rally from here, but we could have said that over the last couple of months. It's the path of least resistance for now is down. So it's step out of the way while that's the case. It's look, I think that's all we can say there, Rog. It's it's not the time for CSL.
Yeah, exactly. I think it once again does come down to your rules, your trading strategy, and what your purpose is, what your goal is with this stock. Once again, if you're a long-term hold, obviously it's a quite popular stock, CSL. So if you're long-term, then maybe it's right. But if it's certainly the way we're educating and trading actively, it's not looking right about now, is it? So. All right. I think that will be it. Some good, interesting comments following that. Sorry, we didn't. If you can't get your tickers, but we do have to draw a line in the sand somewhere, right? And it was up there. But interesting comments, and we should have a discussion on your favorite book. Maybe you can tell us that, Jace. What's your favorite book in trading and investing?
All-time favorites, Market Wizards. The Market Wizards book. It was first published back in the late 1980s, and it's the original one. There's a whole series of them. The first one is my favourite, and I've actually given it to my son recently to read, and he's been going through and telling me it's all interesting. And some of it's dated in that, like, there's no trading floors and stuff anymore. Some of the strategies these trading greats used to use no longer applicable, but many things are still completely in line with how good process would be constructed now. It's so I really like that book. It's how I got my start, how I got to start thinking about systems and processes and trading rules and such. Look, lots of there's lots of really good information out there. I think maybe when you're starting out, you're reading widely, trying to find something that makes sense to you that you can gravitate to, but then start to narrow it down and focus on a particular path. If you're technical or you're fundamental or your system or your discretionary or your reversion to the mean or trend or whatever it may be, and get good at what you do. And I think there's a lot of good information around all sorts of things. So that'd be my starting point. Market Wizards. One of the good things about that is there's the Jack Swagger who wrote the book. He interviews might be 20 different traders or something like that, and they're all different. They've got different approaches. So I read the whole book, and then I found myself coming back to I think it might have been 2 or 3 chapters where I really liked the style, and everything else was interesting, but I was able to get a broad look at many different approaches and go, I like this. And of course, it was systematic trend following, and that was for me.
Yeah, good tips around that book. I've had that on my list for a long time, but there's quite a few, right? So maybe I just got to go back to the original. Kirby's mentioned how CSL's in a stage 4 of the Stan Weinstein. Maybe I've botched that up, but have a look at that Stein Weinstein stage analysis.
Yeah, that's it. Stan's got a good book too. Very, very similar to what I talk about in terms of breakouts and trading with trends and wide trailing stops and not buying when a stock is in decline. It's so lots of good stuff out there.
We could go on forever, Jace, but thank you everyone for coming along once again. Appreciate all your time, and I appreciate all your time, Jason, in educating us so wisely once again. Don't forget to like and subscribe or comment below, obviously, and check out Motion Trader. The Motion Trader, we've been talking about that. There's another comment there from Jen about your Friday strategy session as well. So go and check that out on the YouTube. On just search Motion Trader, obviously, and you'll find Jason's channel there. Otherwise, Jace, thanks once again, and we'll catch you next week, everyone.
Yeah, that's been great. Thanks, Rog. Thanks everyone for joining us. Next week for sure. Look forward to it.
Take care, everyone. Bye-bye.